Hello, I'm Chad, this is Matt. As you all know, last night Russian military forces attacked a broad range of targets across Ukraine. Today we want to share with you how we're viewing these events amid the larger market decline so far in 2022.
Stock market drawdowns from geopolitical shocks average about 5%, with recovery lasting under 2 months. But larger conflicts in sensitive regions can be deeper and last longer. For context, Russia's economy, measured by GDP, is about 2% of the global economy, and Ukraine is about 0.6%. So all in, less than 3% of global economy is being roiled by these events.
But that doesn't mean it can't be a bit unnerving. Broader questions of the long-term impact on US and European diplomatic and geopolitical goals, as well as the conflict's impact on US national interests, are significant, but not in themselves market moving. We do expect further market volatility as the situation unfolds, and elevated uncertainty may persist for several weeks. But if the conflict is contained, we do not expect long-lasting contagion to broader markets.
As a spillover effect, upward pressure on commodity prices already impacted by COVID-19 supply chain disruptions may see a more sustained impact as economic sanctions play out, and will probably be the main source of risk for possible broader economic repercussions. Earlier momentum in European equities relative to the US may also stall out as the crisis plays out.
There may be some market opportunities for active traders during the crisis, but for most investors, we believe understanding the typical market response to geopolitical risks and focusing on where we're likely to be at the end of the year, rather than at the end of the next week or month, is likely the best response. We will see long-term fundamentals drive the markets. But a feature of markets is short-term swings driven by emotions, in this case fear. Again, while it can be unsettling, it is a normal feature of the markets.
That begs the question, what could be next for stocks? Looking at various major geopolitical and historical events since World War II, we found that if the economy can avoid a recession, most of the events aren't major negatives for stocks. And in fact, if there is no recession, stocks are up more than 10% a year later versus down 10% if there is a recession. We do not see a recession this year based on a strong consumer and corporate backdrop. Therefore, investors could use this volatility as an opportunity.
Putting Ukraine aside for a minute, it's worth noting that midterm years can be quite weak early in the year. We've looked at this before. Going back to 1950, in midterm election years, the market has gone down early in the year and then grinded through the summer and the fall, only to increase again in the fourth quarter. With or without Ukraine, this is a possibility.
Then there's sentiment. We know how sour it is, which should surprise no one. The market has worn people down, and it's not as if the news is great either. Perhaps that's why the investors' intelligence bears have shot up to 31%, which is the highest reading since spring of 2020, right after COVID. They're not at the peak of 40% yet, but they've doubled since November.
In the stock market, we're all like teenagers. We hate to wait, and we want instant gratification. The markets, though, they've got something else in mind, don't they?
So while we're waiting to finally get there, let's prepare ourselves for what we're going to see. We are going to see the Dow Jones quoted in points. The Dow is down 700 points today. We should focus instead on the percentage gain or loss, if anything. 700 points is just over 2% today, whereas that would have represented over a 14% move in 2009. So be wary of the Dow in points.
And they will show it in that bright red banner across the bottom of the screen. And lastly, we're going to see fear-provoking words like plunge and crash. So beware, their goal is not to provide quality information, but to keep you glued to the screen and keep you on alert.
we are actively reviewing positions for rebalancing opportunities and other forms of proactive investment management.
So be well out there, and please do call or email us if you're getting anxious. We're more than happy to have those conversations with you. Thank you, and have a great day.